Okay, Portfolio Builder members, welcome to our June 8th trade alert. Today we're adding the 9/18/2020 25 strike VXX put option to your portfolio ahead of a Fed announcement this Wednesday. People are hoping that they're going to announce the potential for a yield curve control program, which would essentially mean massive amounts of new quantitative easing. But typically the Fed's reacting to crises and not when the markets stabilize. So I do think that this will not be something put on the table currently, although this is a very important announcement coming out Wednesday. So let's go to a little lower in the trade alert document. Per $37,500 following the trading strategy, we're adding to our VIX position with the 9/18/2020 25 strike VXX put option. Now, if anyone wants to post the prices they're getting filled, I would love to make sure we're all getting a very similar fill. Okay, Keith is in for 315. I'll keep a look at that as we keep going through the trade alert. If you're a new member today, you can build out the full portfolio. And I'm going to now walk through how everyone following the trading system should have their assets allocated. Ernest is in at 315. Very good. Okay, so step one, per $37,500 to invest, buy the following ETF. Step one, we have the 100 shares of the TLT ETF. This is the US 30-year Treasury deflation hedge. My target is $180 plus by the election. So we'll go into that analysis soon. But the markets are extremely distorted right now because of central banks printing trillions of dollars, giving out all the wrong signals for the long-term value of these different assets in the markets. Okay, Mike's in for 314. The next position we have is high yield corporate bonds. This starts us off with a 5.7% yield, which is beautiful because it does finance our downside protection for HYG. Now, this is highly correlated to the Russell 2000, which is shooting up this morning. And again, our target for this is around 97.50 at a maximum before I'd want to lock in those gains with an in-the-money put. Jack's asking about those TLT call options. Well, yeah, I do want to wait until after that Wednesday announcement, Jack, to deal with the TLT call option that's expiring this month. So I'm still waiting for that information at this point in time. Okay, the next position is the 100 shares of GDX. If we're going to keep the market at this valuation, which is above .com valuations right now, extremely unsustainable, the only way we're going to pull it off will be with controlling the bond market. And that does mean massive amounts of quantitative easing beyond what we currently have. If the Fed does want to do yield curve control to protect the bond market, it's going to have to unleash potentially trillions and trillions of dollars to allow everyone out of their bond positions. And this would definitely incite a massive rally in stocks and gold. Again, the Fed typically does these type of policy actions after a crash like we saw in March, and not after a massive bubble, which we've seen in the last few months. So my bet is that he's not going to be doing yield curve control or negative interest rates anytime soon, and the market's really on its own. They'll be primarily allowing banks to have access to liquidity through repo operations, which we will take a look at it. Next position is USO. This plays WTI oil. And the bottom line here is companies will go bust until the price of oil rises. Right now it's at a very low price, and this does play a great hedge against our larger bond position. So with each of these assets, we're buying 100 shares and it creates a very well-balanced portfolio that's essentially half bullish and inflationary, which is HYG, GDX, and USO. And then the other half of our portfolio is in the deflationary asset, which is the TLT. Okay, step 2 is to buy the following protective puts for your core positions. So each position has a downside put option to protect it at different durations based on the expectations of each asset. So in the TLT, we're looking at the potential for a bond market breakdown as well as a crash in the value of the dollar. This was starting to unfold last week, and this is the big move that I do see taking the stock market down with it. So we'll go into more analysis of this, but the bottom line is the Fed's only buying $20 billion worth of bonds per week currently, but the Treasury is trying to go out and sell over $300 billion. And this is a trend that is not going to stop anytime soon. The first month of selling these bonds with low QE went relatively smooth. We didn't see the bond market having much trouble at all. But really in the last 3 trading days of last week, we saw that the yields, especially on the 10-year, were starting to spike. And that was what I was anticipating could have happened last month. It's beginning to occur currently. So we can go look at that 2018 situation where you had a great stock market, record low unemployment, trade deal with China, all sorts of goodies. And the rising bond yields created a big Christmas massacre crash that did force the Fed to, again, react. HYG, we have the 626.77 strike put. GDX, we have the 821.28 strike GDX put. Now keep in mind, if you do have that 35 strike GDX put from a previous trade, we're still holding that. And then with USO, older members have the pre-split USO put. You do not need this one if you have your original puts. If you're just starting to follow the program, we're recommending the January 15, 2021 20 strike USO put. Step 3, we have 2 blow off top hedges. Okay, so we're looking at the 821.27 strike VXX put. This just needs the overall equity market to stay flat or travel higher to generate very nice returns. And so we have 2 of these different VIX put options in the portfolio now. One is the 821.27 and the other is the 918.25 strike. Finally, per $75,000 following the program, we have these speculative option trades aiming for 500 to 5,000% returns from a stock crash. And I will say that without yield curve control, the dynamics of this market remain exactly the same. So they did an emergency printing to protect the bond market in March, and that resulted in a bubble up of assets, but it also resulted in a new bond crash, and also the value of the dollar is losing its value against other currencies quite rapidly right now. So this is a bigger problem for the Fed that must be addressed in the very near future. So that's what's mainly being looked at as key news this week. Now, for our downside bets, we have the QQQ put. These are great companies, but there's .com level concentration of wealth into this group of companies. So if you get a panic, you're going to have more selling in the QQQ relative to other indexes and different securities. The next trade we have is a put option on Apple. So keep in mind, we have a countdown until we pull away semiconductors from China's biggest phone producer, Huawei. What's the potential retaliation? Give Apple some trouble. So that is the key reason for this downside hedge. And then finally, we have a lot of bills being passed, memorandums essentially wanting to kick Chinese companies out of US exchanges. these companies are now starting to double list in Hong Kong as they see what's coming down the pipeline. And the main thing is that the Chinese companies do not allow US auditors to check their books because it's against the code of law in China, as the Communist Party wants to keep their accounting systems and networks of how their government actually operates top secret. So that is one thing I highly doubt the Chinese will ever agree to. So these give you 3 different downside put options. There's a chance that if FXI were completely delisted, that this could go to a value of 0 and could be potentially our highest returning put option of the group. Now, if you're an old member, we're still hanging on to the following positions, but we're not recommending new members pick up these puts at this current moment in time. So we have 5 SPY puts that we had bought literally the day before the Fed came out with its $2.5 trillion of stimulus or money printing, but remain on hold. So those have not changed, but are not currently recommended for new members yet. The next position that we have to look at exiting in the near future is this 619 160 TLT call option. The January 15th still has a lot of time premium on it, but do expect to potentially sell our 619 160 TLT call either Thursday or Friday of this week. Now, in our buy and hold strategy, this is ideal for portfolios that have less than $30,000, and it is very closely tracking the same overall strategy as above, but without options. So per $1,000, we have no changes today as of the positioning last week, but per $1,000, you have the Inverse Technology ETF, TECS, 1 share of the Inverse Bank ETF, FAS, 2 shares of the Inverse Chinese ETF, Yang, 3 shares of the 30-year Treasury, the TLT, 5 shares of GDX, Gold Miners ETF, and then 3 shares of HYG, High Yield Corporate Bond ETF. If we go further, we can look at how our track record is performing. And first we have our bootcamp trades. So in the bootcamp, we have 3 primary trades. One is shorting the Hong Kong currency. And we also have a silver play and a QQQ put option that currently is doing quite well in both of those open positions. In the main advisory, we are having a period of drawdown. So in the first quarter, the S&P 500 gave investors drawdown of approximately 34%. We did relatively well over that period. However, there was a moment in time where the key hedge of the world in March, which is that 30-year Treasury was supposed to protect all downside risk for equity exposure, snapped. And that's what caused the Fed to do something they've never done in a crisis before, which is rush out with QE before the problems in the economy had been solved. So in the last several market crashes, there was well over a year of just simply low interest rates, lots of government debt being sold to cover up the losses in the economy. And then after there was a real recovery in the underlying economy, they actually came in with QE to take those bonds off the central bank's hands and then allow that to get back into stocks and restart the next bull market in equities. This time around, the crash was unprecedented and did force the Fed to do QE literally days into the market crash and crisis. So very distorted markets currently from that. Now, in our positions, we did pick up some some SPY put options, as it did look like the Fed was going to stick to its normal plan. But literally a day after that, they did come in with that massive amount of money printing, and we've seen this remarkable rally in the stock market. Now, what was the cost of that? Well, the cost of that was several $1 trillion of money printing, number one. But number two, we're now seeing the dollar crash, and we're starting to see yield spike on that 10-year Treasury. which is a huge problem for the market moving forward. So we've had a bit of drawdown, but I do want to point out that those put options have up to 2 years of duration, where we have over 90% of our drawdown. And so we still have plenty of time for these dynamics to work out. And that's why we did choose put options with lots of time premium. So again, these are not closed positions and not a realized loss from April. In our buy and hold portfolio, we have a slightly larger drawdown in June. Our inverse equity exposure ETFs are facing the majority of that drawdown. But however, once again, the dynamics still remain exactly the same, and we're still highly confident in our positioning. Now, the next piece of information I want to review is where we may see the stress in the US banking system with the basically the deficit dynamic starting to really take hold. Okay, so the Fed has continued to drop its asset purchases to as low as 20 billion this week. And again, that's backdropped against 300 plus billion dollars a week the government has to sell. So that money has to come from somewhere, and now the Fed is not buying that debt. So where is it going to come from? Well, obviously it's going to have to be pulled out of other markets. And the way we can see when liquidity is getting tight is by watching the daily repo operations. This is where primary dealers put their treasuries or mortgage-backed securities over at the Fed in exchange for dollars. So they only do this when they've run out of cash. And so these institutions have to buy the US debt. If foreigners are not picking it up, we will see US banks quickly have to use the repo to keep their banking system liquid. So let's see what we've got today. So far, they did 53 billion with the term repo. So this gives you 20 business days in terms of a loan. And for the overnight repo, we saw 67 billion. So we're starting to see the stress in the US banking system grow by the day as this dynamic is not going to change unless the government decides to dramatically reduce its budget, which is why the stock market has rallied. They have to keep selling this debt every week. Okay, so what caused the economy to crash? Why did we have this action in March, and what's coming down the pipeline? So I do want to take a look at the key underlying problem, and that is primarily a demand shock, which was caused by lockdowns, and that was caused obviously by the virus. So we got to ask ourselves, have we really gotten past the pain, or is the underlying core issue for the economy still well in effect? And so we'll take a look at that, but let's first look at the overall situation. This is total confirmed cases and total deaths. And so we can see the markets celebrating reopening the economy and successfully flattening the curve. But what did it take? It took approximately 2 months of global lockdowns to achieve a flattening of the curve. But what have we done in the last 2 weeks? Well, we've got probably millions of people out protesting in tight quarters, almost guaranteeing that this will begin to spread once again. So I think it's only a matter of weeks now before we can start seeing exponential growth of cases, and then double that time frame until you start seeing an exponential growth of deaths once again. So 3 weeks out, we should be seeing the confirmed cases start to really ramp up. And then 6 weeks later, I would imagine you'll see the deaths begin to ramp up once again. Here's the picture in the US, same story. However, we're seeing that states like Texas, Arizona, which have been the bravest to reopen their economy quickly, are already seeing spiking cases and deaths In fact, if we go to some of the most crowded areas where these protests began, they're already seeing exponential growth of new cases at this time. Rick, yeah, we do have the 20 FXI puts for quite some time. So yeah, we've had that on the books for quite some time. Okay, so here's the problem, and I've updated this data. So the information is coming out that it's pretty much, and this is very hard data to get. They don't seem to really publish much of this. So this is primarily based on the data from New York, and it's at least a month old. But in New York, for example, something like 90% of the total deaths were from people over 45 years old, which is around 180 million people in the United States. Okay, so that is the risk group. Now, the bad news is this is the main spenders, the primary driver of the economy are the ones at risk. So let's just look at the data we have. And essentially, I'm trying to get an idea of the mortality rate and the hospitalization rate and look at how our hospital system can handle that to be able to predict what the governments and local mayors and governors will do to protect their people, but try not to bankrupt their state. And so this is what we have so far. Antibodies are the testing that's just now starting to get a lot of information out, much of which is coming from Florida and Arizona. It's not clear what percentage of the people who do have immunity will show up with antibody data, but we're getting results that are coming in anywhere from 1 to really 4%. So I've thrown in a range of possibilities here between 1 to 5% of the US population currently, at least in the over 45 age group, have contracted the virus. And so then we can extrapolate how many people would die if they let this just rip through society and don't protect this group of people. And what would this do to our hospital system? So if we can assume that 90% of the deaths are going to be over 45 years old and that there's 112,054 total deaths currently, and then we can look at the antibody data coming in anywhere from 1 to 5%. I personally think it's going to be around 1% of the population. Remember, an antibody test requires it's a serology test. So you have to give blood, and most likely people who are going to go to that extent to get this test are quite concerned that they may have contracted it. So you're not going to attract people who believe they haven't had it and are being very precautious. So I do think we're going to be on the lower range of this. And I want to point out first off that the flu mortality rate is around it's about 1/10 of 1%, and the hospitalization rate is around 1.3. So we got to remember, this is what put us in this mess in the first place. And is it past us, or is it just in the first wave and now we're going to create a massive second wave? So if we have these different antibody rates between 1 and 5%, we can see our mortality rate for 45-plus-year-olds is between 1 and 5.6%, which means if we don't protect this population and try to go back to the way things were, we're looking at potentially 2 to 10 million deaths just from that age range. So that's quite startling and most likely not politically acceptable. Now, the hospitalization rate is really what's going to be more concerning. And so I'm assuming that we're able to save, for every one person who's passed away, we can save another. And so that save rate may be much higher than reality. So these hospitalization rates very well could be on the low spectrum. But it's important to know we have 100,000 ICU beds in the US. They're currently occupied at about 60 to 70%. And that was achieved again by having a 2-month lockdown and extreme social distancing rules, which have been just completely forgotten about in the last 2 weeks. So we're now looking at 3 weeks from spikes in cases, and another 6 weeks before we start seeing spikes in uh, potentially deaths. Now, I do want to say most of these protesters tend to have masks on, so we'll see how effective that is in an outside setting. But regardless, I am quite concerned we will see a big wave too. And many of these protesters are younger, but that doesn't matter. That's how we end up spreading it, is because the younger group thinks they're immune or it's not a risk to them. So anyways, if we look at the hospitalization rate, anywhere from 2 to 12% of the people that contract the virus will need a hospital bed and very specialized care. And if this, again, if there's no vaccine and this plays out over the next 12 to months, then you're looking at needing anywhere from 300,000 hospital beds per month up to 1.8 million. If again, if we were to just completely try to go back to normal and not protect this older group. So clearly, there's just nowhere near that many hospital beds available, and the risk for further lockdowns or restrictions to commerce are very, very high at this point in time. And again, a lot of people are wondering, was this really necessary to do the lockdown? Um, Maybe it slowed it down, but perhaps there, in the long run, without a vaccine, there's no real solution to protecting everybody. We can simply try to keep the hospital system from being overwhelmed. And again, we can see right when the average deaths should have been dropping going into the summer, we had a record spike here in the US of deaths. So again, the evidence does show that this is a extremely dangerous virus, not just for mortality rates, but also with the hospitalization rates. We have the same data from Europe, so we do have the same core problem. Here's a look at your schedule of treasury purchases updated for the week. And so you can see very, very little bond purchases by the Fed scheduled for this week, which creates that dynamic where you have 300 billion in debt to sell, but perhaps not enough people to buy it. Here's the updated Fed's balance sheet from last Thursday, and we can see what they're buying, what they're selling. They bought $21 billion of treasuries. It should be less this week. They also picked up corporate credit, 1.2 billion. So they're barely touching that corporate credit market, but that's where a lot of people are focusing their attention on currently. At the end of the day, the growth of the balance sheet is plummeting. And this is because if you do too much QE, you create inflation expectations, which makes bond yields rise. And this is the worst time possible to have a really a crashing bond market, because we need to sell 300 billion plus per week to fund all these stimulus bills that we've passed. Now, a lot of people are wondering, is this inflation or deflation we're fighting? And so the latest inflation print was 0.3. And again, that's something that would make you want to buy bonds, not stocks. But again, we had this massive stimulus to distort markets, creating a lot of confusion. And we're seeing this pressure hit the bond market and dollar really just in the last 3 days of the previous trading week. Now, here's the bigger picture of the federal funds rate. And again, every time the Fed has had to cut rates as low as possible, almost with 100% accuracy, this has resulted in a stock crash. And the main idea is the Fed predicts problems in the economy. And so the solution is to raise the capital at the government level, fix the holes in the ship, and then pull out your QE to take those bonds off the bank's hands, deliver the bank's big profits from their investment with the government, and then turn that money to now a healthy stock market that can actually grow. And so you tend to get a stock market crash when there are significant rate cuts, because this incentivizes investment into bonds. Now, what happened this time that's different? The bond market was not doing its job. It was collapsing because this is the worst financial crisis in the history of the world. And we're just slowly starting to see the effects of that. So what comes next is lots of bankruptcies. And uh, now that the Fed has stopped printing, we're going to see which businesses succeed and which fail. And this is going to take probably at least a year to play out in its entirety. Now, if we can't get a vaccine and the data we have on the deadliness of this is accurate, which it does appear to be very accurate, then this could turn into a much longer downturn in the markets. Here's the Treasury purchases or sales this week. So we do see quite a bit hitting the 3-year, 10-year, and 30-year treasuries. So this is, again, what the market's very concerned about is rising yields on the 10-year as well as the 30-year. And if the Fed wants to prevent that from happening, that's when they would unleash what they're calling yield curve control. And that would essentially cue the market to dump all their treasuries and buy stocks, and again, would force the Fed to dramatically increase its balance sheet. There's $16 trillion that could be exited in outstanding debt. And so that's just really quite a nuclear option for the Fed. I highly doubt that they will begin this before there is more turmoil in the markets. We've never seen them playing with interest rates or doing QE when the stock market or the NASDAQ's at new highs. Only when the market's been selling off very rapidly do we see them intervene in that type of extreme. Okay, Bill says, yeah, so Bill, this is the breakdown of the debt they're selling currently that's been announced this day. And all the debt has to be paid from somewhere, Bill. So it's not just the long end of the treasury curve. It's also the entire treasury curve that's going to be sucking money out of other markets, and at a time when the Fed's not buying it up. So here's your 100-year chart of the Dow. And again, if we are really in a demand shock and a highly deflationary period of time, you want to study 1929 through 1935. Market was flying up just like it is now, but the underlying economy was not strong. And you ended up with the Great Depression and the biggest decline in the stock market in history. If we thought we're going into an hyperinflationary period, we'd want to study 1965 to 1980. That's where Paul Volcker had to hike interest rates extremely high because inflation was running away and they couldn't get it under control. During that period, you ended up with a stock and bond crash overall for a good 15-year period. And had you bought 1965 and held, you would have to go all the way to 1990, a 30-year hold just to break even. So again, this type of movement happens when you have too much debt and it becomes unsustainable. And right now at this time, we have record levels of debt to GDP for the consumer, corporate, and government in the United States. So we are getting to that point in time where printing money is just not working. Here's your gold copper ratio. So copper again is pointing to rising yields, and this is primarily from this massive amount of QE, just gobbling up every asset under the sun. And so we're starting to see that 10-year treasury react to the signal from copper right now. Here's a look at United States GDP. We'll see where it comes in. The key here is what you want to do is grow your country's GDP at a faster rate than you grow its debt. And so unfortunately, the United States has been doing the opposite really for the last several decades. And now we'll be doing it at the worst measurement in in the last 40 years. So we're going to potentially have debt to GDP that's going to be in the negative 15 to 20% range this year. And the GDP print will probably be somewhere around the 2017 or 2018 level. So again, that's essentially like taking out a loan and then going to your store and buying your own goods and then still losing money on it and saying, look at my GDP. So that's really the mechanism that the United States has been doing to keep pumping its market higher and higher. Here's a look at the GDP growth rate, and you can see it's plummeting. The Atlanta Fed's predicting negative 50% GDP this quarter, which is absolutely horrific. And so we'll just have to see what this recovery looks like. But just remember, with all the stimulus plans, we prevented the inevitable to see which companies thrive and which fail. And that's going to take time to play out. Mike says, what's going on with the Fed? So yeah, there's an announcement Wednesday. The concern is the bond market's starting to have rising yields that are very problematic. And so the market wants to know, what's the plan? Will there be yield curve control? If there is, this would be potentially trillions of extra QE that would have to be put into the market. And my expectation is that they will not do that. Not until there's another crisis and another leg down in the market. So the unemployment data was put out Friday, but quickly a lot of analysts came out and pointed out that there was a lot of funny numbers on that, and that the true unemployment rate is probably around 16% right now. So we've lost probably 2 decades of jobs in a month, and that was with giving every small business under the sun access to capital for free to keep their staff employed. So again, we're going to just have to see what businesses fail, which businesses succeed, and how that affects the employment, because the U.S. economy is 70% consumer, and without a strong consumer, you're not going to have a strong United States stock market. Okay, so that is the main charts I did want to look at on the economic tab. Let's take a quick look at some charts. Okay, so in this chart, we're looking at which market is the most appreciated since the 2008 crash, and that's by far the United States stock market. Nothing else has really even come close, except for perhaps the Japanese stock market, but that stock market's owned 75% or more by the Japanese government. So really not a lot of price discovery in that market. And so that's the main reason we want to focus our puts on the American market, despite it potentially having the stronger companies, especially the technology companies, and very strong banking sector. But the other play we have is shorting China, who's currently actually the best value play right now. But again, we're seeing that the United States is quickly taking responses to try to slow down China and punish them for what's occurred in the last, well, for number one, failing to do their phase one trade deal. And then number two, it's coming more and more evident that this virus was designed in their laboratory, that they've known about it since October. They've covered it up. They protected the surrounding Chinese cities and allowed the people from Wuhan to travel in and out. In fact, it looks like they were purposely trying to get massive infections in Wuhan by throwing all these parties and food festivals for their population before telling everyone, oh, time for a lockdown, and we have a deadly virus spreading. So we have two put option strategies. One is FXI to short the Chinese stock market, but then we can look at which market has the greatest potential sell-off, and that is clearly the US stock market. This chart we'll have to redo, it's not updating. Next chart we're looking at is the US stock market in orange against the price of oil. And so if you don't have a strong oil market, that shows there's low growth, low demand, and that's really a much clearer signal as to what's really going on in the economy. And again, we have a stock market that's ripped higher at the fastest pace in history, completely fueled by the Fed dumping liquidity into the markets, and the oil markets barely rallied even slightly. So this is telling us that there's low growth, low demand, and that there is not a true recovery. The stock market's just been pumped up with massive, massive money printing. Here is the USO play. So we're looking at WTI futures contracts. When this red line crashed to negative prices, we actually had negative WTI prices for a short minute. That was clearly too much of a crash in the value of WTI. So we picked up USO, and I do like this position, especially when paired with the bond position, because typically those two will not go up at the same time. But USO, again, is extremely low relative to the long-term pricing of oil, whereas if you were to try to hedge it with something like the S&P 500, obviously that's been pumped up, and really without massive growth of earnings and a true recovery, there's no way the S&P 500 can hold these gains, not without more money printing. And the problem with more money printing is the dollar is getting hammered and the bond market's on the verge of crisis here. So then if you crash your bond market, well, that's how you're able to pump the stock market up, was by passing that huge stimulus bill. The Fed gave the Treasury that money with money printing, but now we're trying to actually sell that debt to long-term holders, either US banks or foreign central banks primarily. So we can see USO has been rising as this has been a self-correcting problem. With low oil prices, companies go bust, they stop producing, and now we're starting to see at least a small recovery in demand for oil. So this is working out very well and remains one of my favorite plays. Now in this chart, we're looking at the V-shaped recovery, as they call it. So you can see that S&P 500 crashing all the way to this level and then rocketing right back up. And so the correlated markets that help fuel this that are critical are LQD, that's your investment grade corporate bond fund, and then your high yield bond fund. So this year, the corporations have borrowed another $1 trillion, which much of that tends to go to stock buybacks. So they're borrowing tons of money from the market, which again creates more and more debt to really slow down growth. And so in our position, we like HYG. It is the lagging key market that needs to be propped up if we're going to have some sort of Fed manipulated market recovery. So HYG, again, can catch up to the pack and also delivers that huge 5.7% dividend or monthly dividends, and that is financing downside protection. In this chart, we have gold miners against the EEM or emerging markets. And so a weak dollar tends to be very good for gold miners and emerging markets. So we can see this correlation. And this is our QE hedge. If the central banks are reckless with too much money printing, then our GDX position should by far be the highest returning asset, perhaps next to USO. Another good leading indicator is watching the price of Ethereum against the QQQ. And so in general, the thesis here is that the same big players who use a systematic strategy look at the weakest positions with the biggest returns to take profits on first when they think there's a big change about to occur in the markets. So they can see we can see these weaker assets selling off or rebounding before the larger markets. So we can see in this example, the price of Ethereum began to tank well before the QQQ did last March. And it also was able to find a bottom and start to rebound well before QQQ hit. And why? Well, there's simply more money involved in the QQQ to create a sell-off or a rebound relative to a weaker asset like Ethereum. So this continues to be one of my favorite leading indicators to keep a close eye on. US government bonds, here's that 10-year spiking up right here. This is the main problem with doing too much QE. You upset your bondholders. And remember, there's $16 trillion that could become upset in the US Treasury market. That's outstanding. If those yields spike, this can create a lot of problems. Number one, it'll be very hard for the US to continue selling its debt if everyone holding it is losing money because of rising yields. And then number two, the higher these yields rise, the more likely it's going to cause a shift from capital out of stocks and into bonds. So this is the key prediction we've had, is that the deficits will essentially cause pressure in the bond market until that pressure results in selling of stocks and purchases of bonds. And again, the smart money is not going to go loan the US government $2 to $3 trillion this year and lose on that investment, especially when they essentially control the Federal Reserve. Here's the competing bond markets. And so in this, we're primarily interested in the German interest rate. So the lower the German interest rate goes, the lower we could anticipate the United States interest rate going. And that long-term interest rate's currently at negative 78 basis points, which is the lowest it's been in history. And I do absolutely anticipate the US Treasury to drop below 1 by the election, which would mean the TLT goes above 180. So again, this is all playing out as expected, just a little bit slower than we had anticipated. I was expecting the bond volatility to occur last month, but now it's beginning to occur currently right now, especially last week. In the last 3 trading days, we saw this start to spike. And again, this will result in causing first, probably CTAs to exit these positions and potentially rotate into stocks, exaggerating this yield spike. And then that's what I would expect to cause a reverse trend. And you get these yields dropping much, much lower. So to see this German yield go to negative 78 basis points is beautiful. If we get to 1 on the yield of the 30-year Treasury, the TLT is going to be trading around 180. If we go to 50 basis points, we're going to be looking at a 240 price TLT. If we start to go to 0 or negative, the TLT can actually go above $300. This does remain my favorite play when we look at the grand scheme of things. Okay, Ram says, are bonds and treasuries the same thing? Yeah, so the treasury market's just a name for the US debt. But there's different types of bonds. So we have corporate bonds, we have state bonds, municipal bonds. We've got notes, T-bills. Typically, a bond is going to be something that has at least 20 years with that naming. Okay, so here is the different key currencies against the dollar. So a remarkable move in the Australian currency here, which is interesting because Australia is essentially getting hammered by the Chinese as they were trying to poke at China to allow their scientists to go in and figure out the origins of the virus. So China responded by placing huge tariffs on different exports from Australia to China. So that's a very oddball move to see their currency strengthening when they're potentially at a huge risk of retaliation from China here. The euro has been spiking up, which is interesting as well. In fact, we're seeing just about all of these currencies have a spike. The grand scheme of things, though, is that the world runs on the dollar. The debt markets are all denominated in dollars, so the interest rates have to be paid in dollars. So there's a never-ending demand for dollars. So I do believe these strengthening of these foreign currencies against the dollar will not last because the Fed can't afford for the dollar to crash any lower because that, again, will take out our US bond market. Now your government can't get funded and you have a much bigger mess on your hands. TLT holds the 20-year and 30-year portion of the US Treasury. So essentially we have the most leverage on playing interest rates because it's 20 or 30 times with the duration relative to something like a 10-year or a 3-year or a T-bill. But in general, it's the total Treasury issuance per week that's going to be the drag on the stock market if there's not more quantitative easing, which I don't believe there will be until we have another crisis on our hand. Now, a lot of people want to play gold and think that we're about to break into new highs. But the problem with gold is that it really requires more and more QE. So the QE picture is that the Fed seems to be done. If they do more, it's going to, again, be highly destructive to the bond market. And the good news for QE for gold would be that we now have the ECB with 1.3 trillion in QE planned. But again, that's going to their bond market, not necessarily to anything that would help US markets. We have the Bank of Japan doing $1 trillion of QE, and now it looks like China will come in with another $1 trillion. So overall, we have a mixed picture on the QE. In general, though, gold is an inflation hedge, and everything we have is pointing to deflation for the foreseeable future. It's hard to have inflation when you have so many people unemployed and they're scared to go out and spend their money because they might get sick. Also, there is a lot of good reasons to believe that prices will be lower simply from everyone not paying their rent. In fact, in the last few months, something like half of all rents were not paid. And if you go to the malls, only a quarter of all rents were paid. So this is going to be an absolute crisis for real estate prices. And if you wait, you may get a lower price. That's what creates deflation. People start saving because they believe there will be better prices in the future. Their income is uncertain, and this results in a huge drop in GDP, a demand shock. Now, this is our anticipation of the 1-2 punch we want to capture in the precious metals market. But again, I believe this will come after we have solved the core demand shock problem, which is the virus, which probably is only going to be solved with a vaccine. I don't think it's really realistic to just let this run through society. And again, you end up with the bigger picture of potentially killing millions of Americans who are over 45. So my expectation is we're going to see another stock crash, and then that's when we're going to get the real fun in gold miners in orange, and then at some point rotate into spot silver. So I do see that same 1-2 combo punch occurring, but not until you get your unemployment back down to very low numbers so that your economy is running hot and creating inflationary pressure. And that's why we currently have so many put options protecting our GDX position. Now, the risk is they decide that this is just too risky to pull out QE and that we're going to allow the dollar to weaken significantly and just print our way through this. So if that does occur, which again, I don't think it will, but if it did, and we'll have more information on that Wednesday, then the bubble is going to grow much more rapidly. So if we're seeing this type of a rally on about $2.5 trillion injected into the markets in a very short time period, the cost for yield curve control would be many multiples of that. So you could potentially have $3, $5, $10 trillion worth of bondholders wanting to get out and then chase the very obvious move, which would be in stocks, gold miners, precious metals, Bitcoin, things of that nature. Okay, so those are our charts. Let's look at the news I have for you. Okay, so this fellow is pretty in tune with what's going on with military and usually has pretty good insights. He's an old Army officer, so he's not too happy with the Republicans or the Democrats for that matter. I do like getting his insights and opinions, especially in regards to different military leaders starting to not really support the president at this point in time. This was a speech from Trump about the May's big job increase. So shut down the economy, fire everybody, open it back up. You're going to hire some back. That makes sense, right? But apparently, the job increase wasn't nearly as impressive once you get into the details. The unemployment rate's closer to 16.9, not the 12.9 that they had come out with. In the tweets, here's what we've got for you. So you can see the Fed tapers the daily treasury purchases to 4 billion a day. Okay, so this is what gave you that stock rally. And they're still printing a good bit, but they're slowly tapering this. Currently, they're dropping this by $500 million a day every week. So it went from 5 billion to 4.5 to 4 over the last 3 weeks. And this trend again is not enough to pay for the 300 billion plus being sold every single week. Michael Seebeck says, what is the vehicle for yield control? Yeah, it just means they would go in there and buy every bond that's willing to sell it and control the yield on these bonds to be ultra low so that people who do hold it, wanting it to act as really a hedge for their equity position, could continue to do so with much less risk. But the problem is everybody would realize that this is the cue to sell all your bonds and jump into inflationary products because this could create trillions of dollars in QE in extremely short time period. So it would absolutely crush the value of the dollar and start to really question if if the U.S. government is really solvent or if we're now something like your Hertz bankrupt, which clearly the United States is highly indebted. Here's some info about that. So when the U.S. government's official jobs report for May came out Friday, it included a note at the bottom saying there had been a major error and the unemployment rate should be higher than the widely reported 13%. Overall unemployment rate would have been about 3 percentage points higher than reported, meaning the unemployment rate would be 16%. Either way, anything over 5% is quite bad, and I highly doubt we'll have inflation until it's getting back towards that ultra hot 3.5% that we were leading the market into before this all went so ugly. Okay, demonstrators vow to sustain momentum until change happens. So clearly this global push for protests and riots have a political agenda, and there seems to be no end in sight. Now wait till this cop goes to trial. They've tried to push it from second-degree murder to first-degree murder, which may be very hard to prove. And so I can see an absolute disaster. We have Minneapolis vowing to defund the police. Just complete chaos. This is absolutely mind-boggling what's happening. And again, just 2 weeks ago, you go outside and you're going to kill grandma. But now we got the media and different political leaders out there joining the protests and taking selfies. So, you know, why did this change suddenly? You've killed small businesses around America, allowed a few corporations to just rack up market share like your Walmarts. And now all of a sudden this has gone right out the window. So clearly there is an attack on the current administration because they are messing with the global order. And that again, primarily revolves around the relationship with China. Okay, also, we're seeing censorship at levels never seen before. I've been complaining about conservative censorship for 2 years now, but now it's right out in the open. So we've had a bunch of people get um, fired recently for publishing anything that's against the very liberal left-wing narrative. Philly news editor ousted after daring to question the legitimacy of burning the city's buildings down. I think he had a headline that says buildings matter too, and was fired. Minneapolis mayor loudly booed, subjected to walk of shame after refusing to abolish the police department. Although we did get some information last night that their city council has moved to defund the police. We have police quitting at the fastest pace right now. They said you're now on your own. Um, oh, here's that picture from the buildings matter too. So again, America's just getting trashed. There's something very odd where the local authorities are stepping down and letting everybody just get their rage out. And here we go. Well, the mob of super woke and apparently historically illiterate has struck again, this time in Parliament Square, London, where a large statue of Abraham Lincoln was subject to vandalism amid weekend George Floyd inspired protests. Of course, it was Lincoln who famously declared the Emancipation Proclamation in 1863 amid the Civil War. We also got them writing Churchill's a racist. I guess they don't know he was fighting the Nazis. New York Times editorial page head quits after an internal revolt over Tom Cotton's op-ed. The op-ed was recommending that we use the military to quell these protests. So it says he resigned, but the storyline is that he was fired. Okay, so now we have stripes.com with an article about how General Mattis reaches breaking point, decided to speak out. We're seeing everybody really turn on the current administration right now. Not the Onion. Okay, so here's the Abraham Lincoln statue being vandalized. This is an article here about U.S. bankruptcies soar 48% in May. So again, if you do go to the news tab, you guys can get access to all this information as well. But the bankruptcies are just beginning. We've seen about half of all rent paid. If you go to places like the mall, it's a quarter. And now all these landlords are starting to send out default notices. So we're past that period where a lot of the different local governments had made it illegal to kick residents out because they weren't paying the rent. So that is coming to an end now. And so really the biggest crisis is quite likely in real estate in the very near future here. What's going on with Epstein? Interesting development. Prince Andrew is being called in for questioning. GoFundMe suspends Candace Owens' campaign after George Floyd comments. So a notable conservative Republican with a huge following. John Kelly, latest to rip Trump. Bush also ripping on Trump. And here's potentially a hint at what's going to be coming out of the real estate market. Just one little article clip I had for you. But this was sold for $47 million. It was a full floor apartment in New York, just sold 40% off, 28 million. And we're very early in the pain for the real estate market. So just showing you signs that real estate market could potentially crash. Okay, Iran having a clear second wave forming. We're also seeing this happen in Texas, Arizona, and I do think you'll see just about the whole country having massive growth of new cases in the foreseeable 3 weeks. This market's so bullish, even bankrupt companies are rallying. So Hertz went from something like $1 to $3, driven up by Robinhood investors who took their stimulus checks and been trading their little hearts out. Breaking, millionaire hedge funds being short squeezed by Robinhood millennial pajama traders with their stimulus checks. Just a joke from that group. Guy Laboss says this is like the great financial crisis, but faster. And again, a lot of people are really confused. They think the problems are behind us. We haven't even allowed the problems to materialize because they were so great. We would have had a crashing stock and bond market in March had we not intervened. So looking back, this makes sense what the Fed's done. But the result is now you have a highly distorted stock market that fundamentally can't be justified. And again, the second there's selling pressure, that's going to be a complete disaster for stocks. At the same time, we're pulling away the punch bowl of QE. So Wednesday will really, I believe, cement the expectations that there is not going to be yield curve control because, again, that would mean printing way too much money and risking the value of the dollar. At just under 70%, the response rate to BLS May established payroll survey was a bit low, but it was well within normal range. So the May job surge did really happen. And he's saying recovery is coming, but recoveries take a long time. This is not going to be an instant turnaround. And we'll see that data in the coming months now. Okay, what's going on in Hong Kong for our Hong Kong trade? British Prime Minister says no choice but to offer citizenship to almost 3 million Hong Kongers. We have a bill being passed for United States to also allow Hong Kongers out of there, which is, again, very bad for Hong Kong. We live in a strange country where white kids attack a black cop for the cause of Black Lives Matter. Just showing how absolutely ridiculous these protests are. Completely unhinged from reality and completely politicized. So when will there be an end to these? This is a developing crisis that I think is going to continue to get way out of hand. Now, meanwhile, you got Trump trying to be brave and not wear a mask. We got Biden wearing a mask, really showing the two main angles for this. And in this video, you can see there's a ton of different Trump supporters, 0 of which have a mask. So if you're worried about whether or not there's going to be a second wave, without question, there's going to be a massive second wave. Twitter pulls Trump campaign video of president showing empathy for peaceful protesters. So again, Twitter continues to censor views that are not in line. And remember, Twitter, Snapchat, Google, all these big companies have a huge alliance with China. Google wants to be able to crack into their search market, which thus far they have not, and have partnered with Chinese on artificial intelligence. Twitter simply has a huge percentage of its company owned by Chinese. So they are at the whims of their stock crashing from that. They're currently not in China either. I think there's just a big carrot. If you play ball, you can have access to our market in the long run. And these folks think China is going to become the superpower and the US will be secondary. So these global corporations are making that tough choice to favor China. Wall Street's favorite valuation measure is at .com levels again. .com bubble levels that resulted in great companies like Amazon crashed 98% in the .com crash, and that was about a 2-year market crash before that recovered. Okay, here's some Chinese propaganda that we're going to be looking at. The pandemic hasn't been put under full control in the US. Jobs were added at the expense of loosening epidemic control. Capital is cheering, understandably, but the president Should the president be so elated as if the virus has been forgotten? Well, I think Trump just realizes that we're going to be looking at a Great Depression with starvation if we don't get the economy rolling immediately. Uh, so it's just a very tough position. You're damned if you do, and you're damned if you don't. Here's a clip from Texas. This fellow has a chainsaw out trying to protect local businesses. Whoa. So this is the world we're living in America currently. This is not good. Elena Chan of 233 Hong Kong residents who survived the SARS epidemic, about 40% had chronic fatigue problems after 3 years. Can you imagine 40% of the millions of the current virus patients suffering chronic disability? Drew Brees was talking about disrespecting the flag and got really railed for that comment. And his wife came out and apologized after he came out and apologized, saying, "We are the problem." Trump says next year will be the best year we've ever had. Quoth the Raven, "I can't wait to tell my local pub owner whose businesses have been decimated over the last 2 months not to worry anymore because Dow futures are up 775 points, and that's the same as customers." So again, huge disconnect between the stock market and reality here. Michael Batnick, we've gone from a recession to depression to recovery to euphoria in less than 100 days. And again, what's really happened? Has anything been fixed? No. Only thing that's happened is massive money printing, which is now over. Santiago Capital, despite the fact I think US equities will move much higher over the next few years, I don't believe this rally right now. There, I said it. Again, if we do allow the stock market to crash, allow the bond market to do its job, get a vaccine, then come in with yield curve control, you can really protect all your assets here in America at the same time. It's going to cost letting the stock market have volatility here. But then you come in with your yield curve control, which is just massive QE. And absolutely, you can have massive new highs in equity prices. Again, if you get a vaccine, get your unemployment back low, and get this economy back to where it was last year. But we're just nowhere near that. Okay, now we've got Democrats creating bills that will allow the government to do contact tracing. So if you get sick, now they're going to go look at all the people you've been talking to from your phone data, and then they're going to go force those folks to be traced. So this is something in development. Jim Bianco, no flattening of the curve in the rest of the world. So we can see these cases are growing into new highs currently. Now we've got the police officers kneeling. We've got all the Democrats this morning taking a photo, spread out kneeling. Hu Jian, President Trump doesn't understand why the virus didn't go to other parts of China from Wuhan. Okay, well, that's because they literally barricaded Wuhan. We have all those footage, but they allowed these people to fly out of there while protecting themselves. So that's really the key here, which Trump's been highlighting, and why we can expect some pretty severe retaliation. Keith McCulloch, the risk just went up. The US stock market crashes twice in 2020. Here is the Hong Kong protests. So the big news in Hong Kong is the security law China passed, which essentially allows the Chinese to make anything that they think is a problem for China illegal in Hong Kong and override the Hong Kong government. And that's why we're expecting to see some pretty severe sanctions and problems for Hong Kong in the near future, which again is our Hong Kong trade. Here is a look at your unemployment. So, yep, a little uptick here, but you still wiped out a decade of jobs and are back to the level of jobs we had after the uh, financial crisis of 2008. And again, we haven't even allowed companies to go under yet. We've tried to prevent the pain. So we can see if this will stabilize here or if the unemployment gets bigger and bigger as we have a hard time reopening the economy. We got more violence in the protests in this clip. Here's a look at all these different countries. And again, you can see the virus is spreading very rapidly around the world. And I would anticipate the US will start to rocket right back up here as we try to reopen the economy. And again, these protests are the essential breeding ground for this. This is stunning. At the peak of the speculative fervor in February, small traders bought to open 7.5 million call contracts. This week they bought 12 million. Watch what people do, not what they say. They're full bore bullish on steroids. You can see that huge spike in call options. So the pain trade for the last few weeks was trying to take out all the short sellers, and that created a lot of short squeezes. Now the pain trade would be to bankrupt all these call option buyers. So we'll see how long this bull market rally can occur with the Fed not printing money here coming into June as yields are spiking on bonds. Secretary Pompeo, the Chinese Communist Party's callous attempts to exploit George Floyd's tragic death for its own political gain will fail. During the best of times, Beijing ruthlessly imposes communism. Amid the most difficult challenges, the United States secures freedom. Trump says, I built the greatest economy in the world, the best the US has ever had. Although, again, we had decent GDP from Trump, but not compared to the expansion of debt. So we were borrowing more than we made. So really not that great of an economy. And we've got a long ways to get back to where you were a year ago. We're back to the bottom of the financial crisis in 2008 and 9. We haven't even allowed companies to fail yet. So wait till we see who fails, who succeeds. When all 57 Buffalo police officers on the emergency response team resign because 2 were suspended for knocking down a 75-year-old man and sending him to the hospital, this seems like an opportunity to find 57 new police. Now, we've got police quitting all over the country. So the main thing the police are saying, you're on your own. Okay, let's take a quick break and review our different options with Dean for new members. We got 60 people live. Thank you guys for listening. I'll come back to Q&A and finish looking at our key data we've picked up after we have a little break here from Dean.
All right, thank you, Jason. Appreciate it. All right, folks, a couple things that we're going to cover.
Are you going to put it on your screen now, bud?
Yeah, I'll switch over in just a second.
Okay,
all right, guys. Good. So thank you for your time. Truly appreciate it. And what I'm going to do here now, guys, is jump into a quick presentation, and it's kind of dedicated for the people on trial. Okay, and then Jason will take back over in just a moment here. But give me 1 second while I take over the screen. We'll present what we do, how we can help you, and why real quick. And then Jason will jump back in and lead. All right, guys. So real quick, if you're on a trial, if you have any questions, feel free to give me a call or text me. Okay, specifically, I work with all of our trial customers. Okay, and if you're a customer, you can always call Victor at 505-203-0396 if you have any questions as a customer. And then really, guys, you're going to have tons of hours worth of time each week to jump in and ask Jason questions live. Please feel free to do that, right? Educating you guys on top of just handing you the fish is kind of, what's a little bit of the unique separation from, a financial advisor or hedge fund compared to what we offer. Okay. So if you're on a trial, guys, you have any questions before you get started, just give me a call or send me a text. Okay. And if you're an existing customer, feel free to call Victor or just ask Jason here live in the webinars. Okay. So guys want to welcome and thank you for taking the time to join the investment webinar. Okay, enjoy the education and please ask questions along the way. We truly appreciate your time and attention to show you how boring, successful trading can be when you actually have the right strategy. All right, guys, you're going to meet our team right here. On the left, my name is Dean. I'm a partner and investment consultant. Trial members, I'm your dedicated resource for any questions you have during your trial period. Okay. I'm over here on the left. In the center, you're going to see Jason. He's our founder and our chief investment officer. Okay, so he was the one presenting, the contextual part of the webinar that really covers all of our portfolios, what's going on in the market, and also what's going on in the news feed. And man, it's depressing these days. Okay, Ryan is on the right. He is a partner and a technical director. So Ryan builds all the beautiful automations and makes things just as easy as possible for you guys to connect with us and read all the information that we have and then mimic it in your portfolio. Okay, real quick, guys, want to go over just a couple things in our mission. Okay, our mission is to engineer and build the safest growth for your hard-earned nest egg. Okay, first off and foremost. Number two, we want to educate you on how the central bank controls the market and attach your capital to it. Okay. Number three, we want to answer any and all questions you have about our portfolios in the live interaction with our exclusive webinars. Okay. So you guys, if you have any questions at any point, just jump in and ask them live. We'd love to get that live interaction and provide as much detail and as much context as humanly possible for any questions you may have. Okay. So, oops, let's see here. Oh, that was weird. Okay. So many of our members make the cost of our membership or more in a few weeks, and our trading plan takes less than 2 minutes to execute at noon Eastern on Monday, Wednesday, and Friday. My challenge to you folks is to see how much you can make over the trial. And I want to ask you, is there a better way to build trust? Recently had quite a few people pay for their memberships, by closing out some of the positions that we've gave them. Okay, it's really neat. And so far to date, our best performing trial customers actually did a $97,000 profit during their trial period. So extremely proud about that, and look to see who's going to beat him. Okay, we're going to follow 2 simple rules, guys, when it comes to investing. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Very, very important rules that came from the Oracle himself. Okay, folks, we're going to quickly help you quickly establish a defensive balance for your portfolio. Plus, you'll be ready to profit from a very risky time period with our trade engineer. Okay, trade alerts will be delivered at noon Eastern via text message and email on Monday, Wednesday, and Friday. Okay, that's on the portfolio side, and we engineer our positioning in coordination with the financial system and macro environment. All you have to do is take a few minutes to replicate the trade in your account. It's super simple. All right, guys, and it's really cool. We offer a ton of education that comes along with our service. Not only are we going to help you grow your money, but we're going to educate you on how the market works, how to position into it. Okay, so you're going to get a live video trade alert presentation every Monday, Wednesday, and Friday at noon. Yeah, you can access the live presentation from our trade alert email we send out each of those days. Simply click on the image that looks like a play button to join us here live. Okay, please ask any questions live during the presentation. Just click on the icon to unmute your microphone, or simply type it into the chat box. All right, guys, you can always review our track record by going to portfoliobuilder.io/track-record. We build trust with our clients by being 100% transparent with every position we've ever had. You can always access our track record by going to the URL shown on the screen. Okay, a few things, guys, that you're going to have in place to get the most value out of your trial. Okay, number 1, you're going to need a brokerage account set up, okay, to follow our trading plan. You're going to make sure that has option trading enabled. Okay, so, and you can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Okay. Number 2, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released at noon Eastern. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern. Okay, so you're gonna have a 4-hour time frame each day, guys, to replicate the trades that we have engineered and the portfolio positioning and optimization. Okay, number 2, you're just gonna need that time, right? Number 3, you're gonna need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, the restaurant, and the car. Anywhere you have service, it's important to make sure you entered your cell phone number. When you sign up for a trial, if you use the landline, guys, email the cell phone number to ryan@portfoliobuilder.io, or simply type in your full name, cell phone number, and email to the chat box, and Ryan will get you added to the system. Okay. Last but not least, you are going to need an email provider that's in good working order. So you can join us here in the live webinars, and you can read through the email where we go into great detail about how the portfolio is built. Okay, guys, you can see how we smooth out the weight and avoid big drops with our positions. In December of 2018, the SPY fell 16.63%. Our pro portfolio did a 1.17% profit. Okay, in January, the SPY fell up to 3.45%. Our SPY portfolio made 1%. The option protection did its job. Okay, guys. In February and March, the SPY fell up to 34%, right? So that's S&P 500. Our pro portfolio plus the bootcamp trades did 6.2% in growth. Okay, so just amazing to see. If you're on $1 million account, right, you have $340,000 of drawdown, or you had an increase of 62,000. I'll take the latter any day of the week. So in closure, folks, here's the nuts and bolts of it. We're going to show you how to be defensive, balanced, and profitable in this market condition, unlike 99% of US investors. Okay, guys. Jason, our Chief Investment Officer, will be covering the build out of this portfolio today, live in the webinar, and we're going to do that 3 days a week, guys. And if you do go to the lifetime access, you do get an exclusive webinar on Tuesdays to literally just ask Jason any question under the sun. A lot of people like to just get a kind of one-on-one review of their portfolio, and Jason is going to offer that opportunity every Tuesday to you if you're on the lifetime schedule for us. Okay. And you'll be the investor buying when there's blood in the streets and everyone else is scrambling to close out huge losses. Okay. And we have some really tricky time coming into the market, guys. Okay. You're now living in the most risky time period since 1929 as an investor. Okay. However, we're absolutely positioned to grow wealth safely as the dumb money decimates their wealth in this collapse. And I want to ask you, are you ready to get defensive and grow your wealth in this havoc? Okay, more people lost their jobs, guys, in April than the entire great financial recession. Okay, so how can we help you and your family? Okay, we have 2 portfolios that you can build with us today, depending on your capital investment. We also have our educational bootcamp that will deep dive into our education and deliver our high alpha trade alerts. Okay, closed out trades, guys, in the bootcamp are averaging over 75% return. So huge alpha ROI if that's what you're looking for. Okay. Now we do have on the portfolio side, we do have 2 options for you. Okay. The buy and hold portfolio, guys, is great if you have $30,000 or less. Okay. This portfolio simply uses ETFs to be long or short specific asset classes. Minimal changes were needed to the portfolio throughout the year. In 2019, we only made 5 changes total. We've made exactly 5 changes so far this year. Okay, you won't be utilizing options with the buy and hold. It's real simple, guys. And you're going to have 1 live webinar every single Monday. Okay, and our trades are done at 12 Eastern as well. We had a 25.31% ROI in 2020 and 0 quarterly drawdown over that time period. Okay, now the pro portfolio, which is what I'm currently using with a substantial amount of capital in my IRA. Okay. You're going to have guys, really a minimum of 75,000 to build this portfolio. Okay. And you're going to have at least that much to build everything out. Okay. But this portfolio, guys, is going to show you how to trade like the best hedge fund managers in the business without the 2% management fee and 20% performance fees. Okay. And it's really neat, guys. We actually have a lifetime option too. So you can pay our fee once and never have another fee to be helped for the rest of your life. Something you're never going to find in an advisor or a hedge fund. Okay, changes will be made on a weekly basis to ensure maximum capital and maximal protection of your capital. We've had 0 quarterly drawdown in extremely risky time periods, profitable returns in market soft periods. Okay, we have a sophisticated balance of core asset classes, but really on your side, you simply own the ETFs. Okay, you won't have to go through the 1,000 hours worth of work to understand what to own at certain time periods and why. Okay, I just have to replicate what we do. And you're going to get 3 live webinars each week, folks. Okay. And we're going to teach you what we know. Okay. Pro members really enjoy the exclusive content produced in the Thursday webinars as well. Okay, and you are going to get a 1-year access to our $10,000 bootcamp program free. And seriously, guys, this offer won't last long, so take advantage of it before it's gone. Okay. So in conclusion here, guys, don't let your hard-earned nest egg be decimated. We've all worked way too hard for it. Okay. Sign up from the URL in the chat box to protect your portfolio and profit. Okay. From today's environment. All right. Just click the link below and get your access now. And give me just 1 second here, guys. I'm gonna go ahead and post that into the chat box so you can get that awesome bonus today. Okay, and I need to change my slide up here. It says you're gonna get the $10,000 bootcamp program for 30 days. You're actually gonna get access to it, guys, for an entire year. So take a look, guys. Click on the link that's in the chat box now. And if you guys have any questions, feel free to ask myself or Jason before you get started. Okay, guys, and we absolutely love referral business. If you guys want to help your friends or family as well, we would love that opportunity. Okay, simply refer a friend, family member, or loved one to us, and we'll send you an Amazon gift card anywhere from $100 to $500. Make sure they mention your name when they sign up or call me, and we'll get you the e-gift card. So it's really cool, guys. As soon as their transaction processes, we literally will send you a gift card to you, and it's sent to you instantly via email, and it's really cool. You can use it to buy, maybe the new grill toy you're looking at, or whatever it is you need for your house. Okay, so with that, folks, I'm going to take you to one more page really quick, and then I'm gonna hand it back over to Jason. And but feel free to call me if you guys have any questions. Okay. Now, as far as the pricing options you guys have, we'll go ahead and review that below. Okay, some also, guys, some really cool testimonials. So if you guys want on this page, you can actually click this button and listen to our customers interact with myself and Jason and talk about the money that they've made in certain situations. Okay, so feel free to take a look on that, and all you have to do is tap the play button. Okay, so we have 4 affordable pricing plans, guys. Okay, option number 1, pay annually, and you're going to save 50% on your first year. Okay, normally our multi-asset retirement portfolio with 3 trading webinars per week, when combined with our bootcamp, sells for $9,997. That's the price point we had for the entire year, literally until Jason decided to promote this offer. So take advantage of it, guys. Right now, when you upgrade your free trial to a pro membership, you'll get a lifetime access to our $10,000 bootcamp plus unlimited access to our pro level trading plan for a 50% discount. Okay, so you can click that button right there, and that will get you the annual option to save the most money. Okay, we do have a quarterly option, guys. If you just want to, kind of slowly dip your feet into the pool without jumping all the way in, go for the quarterly. You can always upgrade later on. Okay, you'll get much less of a discount, but that option's available to you as well. Okay, and if you guys want, you could start on a monthly basis as well. And at any point, guys, you want to upgrade your subscription to the annual, just call me and we'll take care of that. Okay. And last but not least, guys, we do have our annual lifetime option. And it's really cool. All of our customers that have signed up for this so far have actually written off that cost, either through their business, okay, or through their trading business. And literally, instead of paying the government $20,000 in federal taxes, why not get our help for the rest of your life and reduce your tax exposure? Okay. A couple of our really smart clients have done that specifically with their businesses. And literally, instead of paying the federal government $20,000 in taxes, you can get our help for the rest of your life by using this membership to offset your tax exposure. Okay. So guys, let us know if you do have any questions at all. Jason and I are happy to answer those. And with that, Jason, I'll let you take back over.
Okay, very good. Thank you, Dean.
My pleasure, bud. Thank you all. And feel free to call me or text me if you guys have any additional questions, okay? Appreciate your time.
Excellent. Okay, I do have some more content to get through here, guys. And if anyone has questions, please post them in the chat box. I have those open at this moment in time. Still have 50 of us live, and I still have a good amount of content to get us through here before we close out today's webinar. Okay, so this is an interesting chart looking at plastic pollution in the oceans. And again, we have a group of people who want to essentially get rid of the oil industry altogether and coal and transition into nuclear power and get carbon emissions down to not just low, but to zero. And that's led by Bill Gates, Michael Bloomberg. There's a whole group of these super elite who are trying to push these policies, which is important because if Joe Biden were to win the election, this could affect not only the relationship with China, but also what's going on in the energy spectrum. So it's important to be aware of that and what changes this could occur. On the other note, if Biden's not in there, another attacking point for the United States and its allies to go after China for not really being a good country in the grand scheme of things. Okay, from the propaganda channel out of China, China is trying to sabotage development of a virus vaccine by Western countries, question mark. I believe some American elites like you must have had the vicious idea of doing this to China. China in your description is actually your own ugly face. So this was all about hospitals and different biotech companies reporting that they were getting that there were Chinese hackers trying to get into their computer systems and steal data. Nothing new for China to try to steal stuff. Okay, so here we have got a bunch of people driving over the American flag. And now, in comparison, here's a clip of how the Chinese police in Shanghai, so this is their premier, one of their premier cities, obviously. This lady pokes the cop so there's a body slammed and the kid goes down. So just showing you kind of the difference here. I believe that a lot of this protests are being organized by, again, a group of people who like the current global power infrastructure, which relies on China to build everything. And they do not want this relationship disrupted, as again, it does. Oh, so you are hearing the audio now, Ryan. Is it just coming through my mic or is it coming through the computer system? Oh, great. Okay, good. I'm glad that's working. I'll turn that audio down a bit. This is in Brussels. This is not just a localized thing. This is happening worldwide. And they're joking that there's all these tiny people in their military trying to fight off this crowd. The Onion, this is a fake picture that's just a joke, but again, right before we went into the Great Depression, had 5 years of negative stock returns, and essentially you had about a 90% crash in the US stock market. The stock market had been going straight up for a good decade in the 20s. Stock market invincible, buy, 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 experts advise. Of course, that's what Wall Street's going to tell us, right? Okay, so what else we got going on? China's UK ambassador, Liu, says abandoning Huawei could mean the Chinese companies may no longer be able to build Britain's nuclear power plants and high-speed rail network. So we're coming into a period of time where you have to pick your side. Either you're on China's team or you're on America's team. And so we have a lot of democratic countries we would assume are our allies. However, they have a better financial relationship with China. So this will be very telling in the coming months. Many officials are talking about extending the national misery into the fall, even into next year. This cannot happen. No one can afford one more day of these lockdown policies or draconian restrictions. So yeah, unfortunately, it's a situation you can't win. Either you have an overwhelmed healthcare system and a lot of deaths and sick people, tragic, or you have a complete implosion of your economy. So they're going to have to find the best mix between the two, and however you slice it, you're not going to have a full operating economy anytime soon, not until there is a vaccine. because again, this is not some hoax. It is a very dangerous vaccine, especially for anyone over 45. This fellow is saying, wow, if you think Churchill was racist, wait until you hear about the guy on the other side. So they crossed out his name, put was racist. Here's some Secret Service going into around the White House. Definitely getting more alarming. What is going on? Who is organizing this global protest? We got, again, people breaking into stores. 50 ATM machines were blown up in Texas. One killed the fellow who's trying to do that. Here they are pulling down a statue of a slave trader and throwing it in. So at least they got one target that matches their protest. Norwegian scientists, this virus does not have a natural origin. Sequences in the surface of the coronavirus indicate it does not come from nature, but is probably developed by Chinese and American scientists. So we're getting all the scientists coming out to verify this, which again, we were predicting as early as the start of February that all this would play out. News recap: China May exports slip back into contraction, imports worst in 4 years. So we're seeing, again, demand shock. The global trade is collapsing. And again, we're just starting to see the effects of this because all the governments tried to delay it with money printing, currency devaluation. I'm starting to believe there's a deep state when Powell, Bush, and Clinton are all on the same side. So now we have Powell joining the bashing of Trump here. This is a little comic. And it says, imagine, if you will, a virus so intelligent that it knows the difference between a Walmart and a church. After saying, stay at home, save lives, and shutting Parliament, Trudeau attends packed protest without social distancing. SPX is approaching the January 2020 lows when unemployment was 3.5% and GDP growth for 2020 was 2%, and earnings growth was expected to be north of 5%. Currently, again, unemployment's closer to 16% so far, and that's with all the money thrown at small business possible to avoid these layoffs. GDP growth is supposed to be negative 50% this quarter, and earnings expectations are all crashing. Jack's interested. So they have a press conference, Jack. So there's no articles about it. Yeah. So the concern is that the bond market is starting to sell off, and what are they going to do about it? They're going to let it do its natural course, which would cause money to flow out of stocks and into bonds. Or are they going to try to do yield curve control? And if they did that, then that would mean the amount of stimulus and, or rather the amount of quantitative easing that we saw in March will look like peanuts compared to what it will cost to do yield curve control. So that would be a very extreme move to do when the market has just rallied this high. Rioters destroying Children's Hospital in Houston. You can come play that video. Billionaires' first move every time is to protect their billions. They will publicly kneel at the murderous feet of the CCP. Think of NBA team owners. And then they will privately sell everything they can and move their money to jurisdictions with English rule of law. So essentially, Hong Kong is losing that democratic legal system, and it's now being replaced with the Chinese rule of law, which again is not just, and no one wants to have their assets just taken away from them. Think about Alibaba. Jack Tan built that massive company, and then once it reached its way to the top, he had to hand it over to the Chinese. So the Chinese are making laws that allow them to freeze Hong Kongers' assets, detain them to China for court, and also make it illegal to be out protesting or showing any signs of disrespect to the Chinese people, their national anthem, anything of that nature. Okay, protesters versus the virus. And so funny enough, this guy's actually wearing a mask, I believe. Just a comic for you. That's what's going to happen if you go out into crowded areas. The path to herd immunity from the long view. So in Philly, just massive amounts of people out doing this. So yeah, whether or not we have a second wave is unquestionably a yes. And it's because of these protests. So that's good news for the vaccine developers. So I do anticipate us playing a pump and dump in the biotech space starting around July when the phase 3 begins for the Oxford and for Moderna. So they're going to give their vaccine to like 10 to 30,000 people and then see several months later what percentage have gained immunity against virus versus those who are on the placebo and don't. So that's good news. We'll know if these guys have a working vaccine probably before the election, and that would be huge. That's really what we need to get out of this mess. I believe this is in, I think it's in England, and it's just a picture of this protest, obviously, but it says, "I hope they open the pub soon." And the little guy next to him says, "Don't be silly, it's not safe." Okay, have we lost our minds? Breaking: Minneapolis City Council votes to dismantle the police. Absolute insanity. Okay, the world as a whole has never been richer and it has never been more heavily in debt, living off of borrowed money. The record shows that for society, the richer we become, the harder it becomes to live within our means. Abundance is harder for us to handle than scarcity. Okay, now here's a something that is relatively bullish in commentary. S&P 500 is up 45% since the Fed announced these barely used 8 emergency programs. Proof just carrying a big gun is all you need. The menace threat is now a permanent feature, which will distort markets, all markets, for a very long time. The gun's there loaded. It's not going anywhere. So he's pointing out that many of these different facilities they put out have not been used. And thus, he's insinuating that there's unlimited QE or access to capital for each of these different markets. The main one that I'm currently watching is the repo market, which again is where the bond market is showing its signs of stress. And for our predictions, really it's just the dynamic of the deficit versus the Fed's willingness to buy those bonds that will create my expectations. And so unless the Fed wants to ramp up its treasury purchases, I remain solidly intact with our positioning. Okay, what happens if a second wave occurs? Watch Arizona cases surging and their hospitals are now at their limit. Are we going to be back into lockdowns? Are we going to just let this rip through society? Some sort of hybrid between the two. Regardless, it's hard to think that our economy will be back to normal anytime soon. And the hospitals in Arizona says ICU beds are nearly at 100% capacity. Doctors urge people in the community to act now to reduce transmission. That's bad. We barely started trying to open up the economy and we're already starting to max out the hospital system. Okay, breaking sources report the NYPD commissioner and chief of department are resigning, and between 300 and 800 officers are retiring immediately. Built by slaves, tear it down. So we've got one of the great pyramids. Digging holes and filling them in on themselves. When trusted voices openly bend the knee to the mob, all credibility is lost. Not to be unexpected, but makes it all their advice, cancel recommendations, basically moot. Within a 48-hour period in Chicago last week, there were 82 shootings with 23 deaths. Silence, no protests there. Okay, let's see. William says, no one can explain how the virus knows the difference between rioters and the rest of us, and the virus knows not to affect. Yeah. So they are a lot wearing masks, which is supposed to reduce your likelihood of getting sick from about 25% down to 3% based on the data I have. So, but a lot of them aren't wearing masks. They're fighting. So clearly, this is a incubation for the virus, and in a worldwide level. Irish media this week went on a relentless campaign of blaming whites for the death of a criminal in the US, but just last night, the Irish boy was beaten by Africans. Nothing on this in the media. And the data is just really hard to push this whole protest. When you look at who's killing African Americans, it's not white people, not by a long stretch. Largely peaceful, 27 officers injured. Pick One BBC News says 27 police officers injured during largely peaceful anti-racism protests in London. Okay, I'm furious. We tanked our economy, put 40 million Americans out of work, not to mention billions of side effects to essentially, in 1 week, act like it never happened. Here's some footage from Vegas. Nobody's wearing a mask. George Conclave's the Fed WSJ story on yield curve control. So this is one article you could come link to, Jack, if you wanted to dig into that. I know you're wondering what to do with your TLT call option, which I think you're a lot over invested relative to my portfolio. So this suggests they are not ready to do yield curve control. I generally agree, but anything goes nowadays as they micromanage all areas of the market. If they skip yield curve control launch, there will likely be trial balloons from Powell at the presser. So we'll see what he has to say this Wednesday about yield curve control. But again, I don't think they're going to pull that out anytime soon. Vandalism and defacing public property is apparently now legal in Washington, D.C. And so they painted defund the police on the road. This is pretty wild. We have hundreds and hundreds of African Americans chanting something closely together. This is the exact group of people have the highest chance of dying from the virus because they tend to be, from just observing, they look like they're over 45 and they're African American. So this has been the highest death rate by far. So what is going on here? It's quite. Black people went to slavery. They need us in crime. They need us in crime. Who's the king? Who's the king? Okay, this is from Twitter. I'm a 33-year-old black male and I have never been oppressed. I eat, sleep, and poop just fine like the next person. I can buy a car, I can buy a home, I can obtain a passport, I can work. I love this country and I'm proud to be an American. I am not oppressed. Jim Bianco, while you're watching AZ, keep an eye on Utah and North Carolina, both of which are spiking. So wave 2 is coming in. It's coming in fast. It's coming in hard. Americans at the bottom are actually living in an autocratic political system under collective rule of the elites. In face of racial discrimination, inequality, and pandemic, they can protest but are powerless to make any real changes. It's a desperate situation. So again, we're also quite likely causing civil unrest in Hong Kong and China, which is why I think they're trying to retaliate against us with what we're seeing here. Okay, so I will lose. This is a great thread. I highly recommend everyone read this thread. I will lose many friends over what I'm about to say. I will possibly be called a racist or a white supremacist, even though I'm a brown man who's been beaten up to a pulp by neo-Nazis wearing steel-toed boots. But maybe, just maybe, the fact that I am getting 100%. Let me pull this up. My information from the Black scholars in the picture, the great Thomas Sowell, Glenn Laurie, Shelby Steele, goes on to list a few, but here's what he has to say. I've been watching the narrative play universally over the heinous killing of George Floyd, and the complete and utter lack of facts about African Americans in the US has been infuriating. Unfortunately, anyone who doesn't submit to the dominant narrative will be called a heretic, a racist, a white supremacist. Still, I can't stop myself. One, Black Lives Matter don't care about Black people. Want evidence? Name me a single time, just one, when they've protested against Black people being killed by other Black people, whether in America or elsewhere. Why is this relevant? Because the biggest cause of death for Black men aged 15 to 45 in the US is other Black men, compared to white people, where it's traffic accidents for younger portion and heart attacks for those over 35. Or how about the Black lives in Sudan, East Timor, or Libya? Why do we only ever hear from Black Lives Matter when it's a white person killing a Black person? Speaking of which, imagine if white people started doing the reverse. Imagine every time a white person was killed by a Black person, there'd be protests, riots, looting, and social media campaigns. First thing to notice is that it would be more frequent because African Americans kill more white people in the US than white people kill African Americans. Should we really start applying the race card every time there's a murder involving more than one pigmentation? Where will it end? Police killings. The video of the murder of George Floyd is so visceral by showing the casual evil with which Officer Derrick kills George Floyd. People are rightly outraged, and no one can honestly defend the officer, who rightly has been arrested and hopefully will spend his remaining years behind bars, although the prosecutor has been idiotic in moving the case from second degree to first degree murder, a burden of proof they will most likely fail to provide. But the only reason people are up in arms about these is that the social media and mainstream media attention focuses disproportionately on these incidents when the victim is Black and the officer isn't. Don't believe me? Let me prove it. You've all heard of Tamir Rice, a 12-year-old Black boy who was murdered when brandishing a toy gun. It was all over the news. There were riots and marches, hashtags, and universal condemnation all over the media. But how many of you have heard of Daniel Shaver, a white man who was showing his friends a scoped air rifle used to exterminate birds, who entered his store and was killed for this? You may remember the case of Sam Du Bois, a Black man who was shot dead for driving his car away from the police. The exact same thing happened before that to Andrew Thomas, a white man driving away from the police. None of you have heard from him. Alton Sterling was a Black man shot dead by the police when reaching into his pocket for his wallet, a travesty. The same thing happened to a white guy named Dylan Noble. Sterling made national headlines. None of us heard a word about Noble. Lauren Simpson was a white teenager who was shot dead by the police in eerily similar circumstances as George Zimmerman killed Trayvon Martin. You've not heard of the former, but demanded justice for the latter. You've not heard of James Boyd, Alfred Redwine, Brandon Stanley, or Mary Hawks, but you've heard of Alton Sterling and Philando Castile. Because the only times police killings makes the news is when the victim is Black and the officer isn't. Here are the FBI statistics. For every 10,000 Black people arrested for violent crime, 3 are killed by the police. For every 10,000 white people arrested for a violent crime, 4 are killed by the police. In 2019, 49 unarmed people were killed by the police. 9 were Black, 19 were white. The likelihood for a Black person being shot by the police is as high as being struck by lightning. Yet we're seeing riots. Every single post on Instagram and Twitter is in support of BLM and denunciation of police in America. Systemic racism, institutionalized racism. Sounds good, don't they? Such powerful words and completely inaccurate. First, let's see what the claims being made are. Both insinuate built-in racism within various official institutions, police, law, governments. Yet, when they are challenged by asking the proponents to provide evidence for these, nothing is provided. Name one single law that is targeting exclusively Black people. Just one. If the police is systematically anti-Black, explain how it is possible that 20% of the police force in America is Black. when they constitute 14% of the population. Blacks are overrepresented within the police force. Now, imagine how incredibly racist it is to say that the 100,000 plus black police officers are too stupid to know that they are working inside and within a racist institution. None of them have gone on 60 Minutes and said, we're being trained to be racist. Seriously? How about government? Well, let's leave aside the fact that America just had a 2-term black president. Some of America's worst run cities have black mayors, black governors, and majority black councils. Look at 2 of the worst cities in America to be black in, Baltimore and Chicago. Why is it that a place where the people in power are black can be worse for African Americans? It goes on and on. It just points out the political agenda behind these protests. There's a bigger play at work here. This is the biggest U.S. junk bond ETF inflow last week, 3.5 billion. That's again what we're playing currently with our exposure to equities, HYG, and an asset that the Fed's just begun to backstop. The Fed's greatest and most urgent problem is to reverse the rise in Treasury yields. When they do yield curve control or something else, it is imperative that this rise in yields be stopped now. So again, we're seeing those yields rise. That will take out the markets all on its own. But if they try to do yield curve control, that is going to create a massive amount of expansion of the Fed's balance sheet, weaken the dollar further, bring into question the solvency of the American government, and push stock prices to even harder to support levels than they already are at. Here's 5 charts that track the economy. Okay, so we're looking at where we were at before the crisis, looking at, again, transit, walking, and driving based on Apple data. So we are starting to see this come back to a more normal level. US restaurant bookings are still way behind, and restaurants may be a huge risk factor in terms of bankruptcies coming in. They hardly make profits if you can keep it packed. If you start having to have 50 or 25% capacity levels, then either they have to jack up prices tremendously, get a huge discount on their lease, but something's got to give. This is not going to work. US hotel occupancy starting to recover. Norway scientists claim report proves the virus was lab made. So this is becoming more and more evident by the day. Bill hitting China for its poor treatment of its Muslims minority on its way to Trump, past the Democratic-led House, past the GOP-led Senate, and this would compel Trump to impose sanctions on and revoke the visas of any officials responsible for Uyghur oppression. Federal budget deficit nears $2 trillion for the fiscal year of 2020. CBO estimates the federal deficit in May totaled $424 billion, double that of last year. So this is the overwhelming key market stress for the foreseeable future, is the massive debt the U.S. has to sell, and the Fed's not buying it. Okay, very good. That does wrap up our news collection for today. Let's see what last questions we have. And so if you're a lifetime member, remember we have a group session tomorrow. I think there's maybe something like 15 or 20 folks in that lifetime crowd right now. And this will be designed specifically to answer your questions, talk about specifics relative to your portfolio, and dig into any trades. So there won't be a presentation that we'll be listening through, just pure Q&A. Also, if you're in the boot camp, you'll be getting your study guide, so materials to study. Wednesday, we will be coming back to our next advisory webinar. Thursday, we'll be covering the Hong Kong trade specifically, as well as the Chinese yuan, and looking at a new broker-dealer option called Oanda. So still getting all the tutorials on that, but that is a new Forex broker we are going to move forward with in endorsing for the CNH trade. So again, if you have a $1 million+ portfolio, you're perfectly fine at Interactive Brokers, shorting the yuan with the futures market. However, if you have a account size smaller than that, I'll be recommending Oanda for the ability to play it at very tiny increments with which will be better suited for smaller portfolios. And then Friday, we'll be right back to our next advisory webinar. It's very good. We kept our whole crowd this entire time. Thanks for sticking with us. I know we're all ready to see our accounts grow and see some of these. We've been predicting the news flow quite accurately, but we want to see this result in profits in our portfolio. I think you can see we've remained stubbornly positioned in the same manner. And now we're starting to see those stresses hit the banking system. So I do think we're getting very close to that moment in time. Any final questions before I wrap up today's webinar? You can always go rewatch this webinar by clicking the link. Thank you, Ron. Okay, very good. Well, we appreciate everybody's time. We will see you back tomorrow if you're a lifetimer, and the rest of the crew back on Wednesday. Thank you very much.